All right, Wheel says, I'm accustomed to trading one lot at a time, and I seem to lose money when I add to a winning trade. So I'm missing something here. Can you explain right and wrong strategies for adding to a position?
Well, it's always been a challenge to me to add into to winning trades. For a long time, I was all in, all out. Been, trying to add into positions over time. I've been at this a long time. Seems I should be much better at that, but it is always a challenge, and it always seems like if I'm in a winning trade and I think it's going to continue to go, and I'm looking for an opportunity to get in, that of course is going to change my risk parameters, right? So, let's say I get long at 10, and I add to that long at 12. Well, now my average price is 11, and that's going to kind of tighten up the risk a little bit. Maybe you're going to be more prone to closing up or tightening up your risk maybe a little bit too soon after something like that, and it ends up turning into a loss. Wheels, get used to the idea of if you're going to add to that position, it doesn't change the risk or the invalidation level of that trade. So here's the opening range in the NASDAQ. If we bought the opening range and we added to that position, well, if we initially added to it in this first 5-minute bar, there's no real pullback. There's no real area for me to move my stop to shorten up that risk. So my risk still has to remain below the low of the opening range. Now, if we bought it here and we added to it here and we have the price up here, now we've had a pullback. We've got a a level where price pulled back to and buyers took over again and began to move price even higher. That gives us the opportunity to limit our risk on that trade. Okay, to below this level. This is a 5-minute chart. That level would be below 96 and a quarter. All right. Well, it also lines up with the weekly kickoff high, which we broke through, came back to, found support at, and continued to push higher. So there's a decent level if we were to have added to a winning position in this first 5 minutes in the NASDAQ.
George Gyra says, hey, have a nice month and a nice week. Well, thank you, George. You also. So here's my question. This comes from George. Do you think that corn market, as one of the three kings of commodities, drives the overall prices of other grain markets? Thanks. Oh, what's your opinion on this? Is there a
Uh,
king? Is there a king of the commodities, or
the king of the grains? Uh, I don't know. I always thought it was soybeans was the king of the grains, the row crops. But I don't think that any of them really could be like coronated the corn king or the soybean king. It depends on plantage, you know, um, yield per acres. It's difficult to know. It's a really interesting question. I guess it depends on what pit you ask the trader that used to trade grains on the floor, because I know Mixted, Mr. Ironimo would say wheat was the king. I know a bunch of people that traded soybeans. They would say soybeans were the king. Grains, corn. Somebody in the corn pit would probably say, yeah, corn is the king. But you also have soybeans, which is also meal and soybean oil. So there's three soybean pits. To me, the king of the grains would be soybeans, because not only do you trade the whole bean, but you also trade the meal and the oil. What an interesting and entertaining question, George.
Tony says, Coach Hoag, on market profile, every section is 30 minutes. So do you take your entries and profits using market profile, or do you zoom in on a 5-minute or 1 minute to get your entries? Basically, what criteria do you use to get in and out of trades and trade management? Thanks.
When I'm actively trading, I try and keep my charts on the 30-minute chart and the market profile. Uh, Using a shorter time frame chart sometimes to get in, the lowest I would go to is about a 5-minute chart to look for one of Dakota's famous 3-bar reversals. To trail, I would probably look at a 5 minute chart or maybe a 1,000 tick chart to trail a stop if I'm going to be trailing a stop. But by and large, most of the decision making when I'm actively trading is based off the market generated information off the market profile. We had a failed upside auction in the NASDAQ today that if we reacted to it quickly, we could have risked maybe 10 points and we could have realized uh, maybe about 80 points of profit in that. It's just a matter of recognizing when the opportunity is fresh. Sometimes you can't wait until confirmation from some of these things that you see in the market profile because confirmation usually costs in trade location. But most of the time, when I'm actively trading, most of the information is coming right off that profile.
There's an infinite amount of answers to this question. How do I hold my runners and keep my losses short?
Mm-hmm.
Uh, in a little more context, never hurts. What type of risk are you playing with? What size of account are you trading in? What kind of time frames are you looking at? But honestly, my humble opinion, how do you keep your losses short? When the market tells you you're wrong, you get out of your trade. The market
Mm-hmm.
will let you know when your trade setup is invalidated, and you should listen to it.
First thing is know when you're wrong and get out. That's the first thing. And when you do have a trade that's going your way, be thinking about, is this congruent with the bigger picture? What is the context of this market that I'm trying to remain in? Is it possible? Is it probable that this runner can keep going? Learn how to trail stops behind runners. That's probably one of the best ways. But Leon, I think one of the things that every trader kind of fights with is nobody likes to take losses, so we go into avoidance. We say, well, the market will come back and make me whole again, and that ends up basically creating bigger losses. And then the other side of that coin, when we have a winner on, it feels so good just to take that winner, especially after sustaining some losses. We just need that winner. So we may lose 500 on trades and make $50 on trades and feel really good about that, but that's not the way it's going to work for you. So first, manage your risk first. Manage your risk first. Always take trades in good trade location, close to points of invalidation. And then just, keep your hands off your mouse for a little bit longer every time you put on a trade. And maybe some of those runners will continue to go for you, and you'll kind of build that muscle to be able to stay in runners for a longer period of time.
Billy's a fan. He says, "Hey Hoag, I love watching your morning routine and thought process, and thank you for taking my question." Billy goes on to ask, "I've heard of few people referring to their ability to sell on the ask or the bid, and vice versa. This was coming from former floor traders. I can't seem to wrap my head around what that means. Does this make sense to you? Buying on the bid and selling on the offer." Uh,
Yeah, Billy, back in the pit, there were some traders that were making really big money, and they didn't look at they never looked at charts. They didn't know how to trade. All they know how to do was to bid the bid and sell the offer. If they bid the bid at 40 and they got hit, they tried to sell 50s or 60s. If they couldn't sell those, they'd hit the bid at 40 and scratch the trade. That was the edge for a lot of traders on the trading floor. They were the true scalpers. They were looking to buy 40s, looking to sell halves, looking to buy halves, looking to sell 60s, looking to sell 60s, looking to buy halves. And that's really what they're talking about. Now, as far as electronic trading is concerned, I think there's a big argument going whether you should always get in on the bid or the offer, or if you should just use a market order to get into your trades. Because if you think about it, you take 1,000 trades in a month and you buy the bid or sell the offer, you're saving yourself 1,000 ticks by doing so. But you're probably also going to miss some trades. So, as far as, trying to work the bid and work the offer, talking about floor people, they were scalpers. They weren't necessarily even actually traders. A lot of them never even looked at a chart. That's what made it so difficult when they tried to move from pit to screen to actually learn how to trade, because all they were trying to do was buy the bid, sell the offer, buy the bid, sell the offer, work the order flow, see the big orders. If there was a big order behind me and it was, there was 1,000 at even, well, I could sell 10 at 90. And if I got 10 sold at 90 and it went 80 and 70 offer, well, I'm making money on that. But if the market turns, I can turn to the broker behind me and say, buy 10. If he sells me the 10, I know I can just lose 10 ticks, but I could make 40, 50, 60, 100 ticks if the market went my way. So that's really what kind of working the bid, working the offer. And again, there's that big argument then on screen trading, whether you should always try and buy the bid or you should always try and sell the offer in screen trading, because, over time, over 1,000 trades, it saves you 1,000 ticks. But again, you might miss some trades as well. It's all depending on you.